A special guest today, Thomas Hayes. He's the chairman of Great Hills Capital. Thomas, welcome to Bloomberg HD.
Thanks for having me, Ali.
Can you please talk about the latest outlook on US economy, especially inflation, and the recent announcement on employment rate of 3.8%?
Yeah, well, as we know, the headline inflation has been coming down precipitously since last summer, from 9.1% down to 3 and change. And I think we'll probably see a 2 handle before the end of the year because a lot of that is shelter. And we're seeing the rents come down and the power shift back to the renters. So that's a positive thing. As it relates to the non-farm payrolls report this week, that was a very, very constructive report from the standpoint that we're now getting data that gives the Fed cover to not only skip in September, which was already kind of priced into the markets. We're seeing about 11% chance of a hike in September, according to Fed funds futures. But also now November is actually come down a little bit from before the report. I think it was about 48% chance of a hike in November. And now it's sitting around 33%. And the reason is we saw the unemployment rate tick up to 3.8%. We also saw the most important thing, as far as I could see, Ali, is the labor force participation rate at 62.8%. A lot of women in particular are going back into the labor force. That is the highest level of participation since June of 2020. So a lot of people are starting to run out of their excess savings and stimulus and going back to work. And what that means is they're putting new supply of labor on the market. And when supply goes up, it gives the employers a little negotiation over wages. And that's why you also saw the average hourly earnings come in at 4.3% versus 4.4% expectation. So positive news all around, giving the Fed cover, getting out of the tightening, winding down the tightening cycle so the economy can be self-sustaining.
And your expectation on the Fed's meeting this month, especially what do you think Fed Chairman Powell will give the message to the public?
Well, I think he's going to do what he's done since day one, is continue to talk hawkish. So he'll probably say, we're going to continue to monitor the data. We've come a long way, but we reserve the right to, increase tightening as needed. And we'll see you in November. And then by November, you will have had 2 more jobs numbers. You'll have a number of inflation prints in the interim. You'll see those rents coming down. And I think by November, the data will give them more cover, even more than what we saw today, to pause once again. And they'll continue to maintain a hawkish stance to keep inflation expectations down. But I think they're done with the tightening. That's not to say they won't remain restrictive, because they probably will keep rates elevated as long as they possibly can. Sometime well into next year, which is constructive, similar to what we saw in the late 90s with a Fed funds rate, which hovered between 5 and 6% back then. I think it'll be a little lower this time, and let the economy grow on its own. So I think all in all, this type of data really gives them pause for making any more abrupt moves.
Thomas, you share outstanding reports, especially on the stock market, on a weekly basis. What is the latest on stock market outlook?
Yeah, well, I think that you've had this excessive pessimism around August and September seasonality. And the problem with that is when everyone's looking for a crash is when you usually don't get it. We had a natural 4 or 5% pullback in early August. That was natural. We saw things get a little frothy at the end of July. But most managers are still very defensively positioned, despite the fact you had a 20% rally in the S&P through July. The Barclays hedge fund index was only up 6%. So you have all of these institutional managers that have to play catch up. So on 3 to 5% pullbacks, they have to be buyers. And that's why even if you see a little bit of chop in the fall, these dips are going to be bought. Those people waiting for a large crash are going to be waiting a long time. But I do think the dynamic is going to shift in that managers are going to look more for the things that have not worked yet. So if they have to catch up performance, they're not going to do so by chasing the Magnificent Seven that are already up 30, 50, 70% in some cases. Those will do fine, but they're going to do less well than they did in the first half of the year. The opportunity is going to be in finding some of those value areas where they haven't yet started to perform, but they can perform tremendously into year end. So our general outlook is indices will do fine, less well than they did in the first half. On average, since 1905, when you have indices up 15 to 20%, S&P 500 up 15 to 20% through July, the rest of the year is actually up another 9%. So we could see mid-single digit gains through year end, but that won't be concentrated in the Magnificent Seven like you saw in the first 5 months of the year. It'll be start to get a lot of catch up under the surface from some value sectors.
Mm-hmm. And my last question on latest US-China relationship. Secretary of Commerce was in China. Before that, Secretary of State, Secretary of Treasury, possible meeting Biden and Xi this month at G20 in India. So what do you think about the US-China relationship? Is it going to be a better relationship or stable? Your thoughts?
Yeah, they're communicating now. And what's basically happened is US business has said to the administration, look, what are you doing here? It's hurting our ability to do business in China. You need to open up communication. So they sent Secretary Raimondo there. She went with the message that we're not looking to decouple. We're interdependent. We need to work together. So this is a big change. The relationship is thawing from fully frozen in the ice age to now thawing and starting regular dialogue and communication. And that's the name of the game. The market just needs to see things moving in the right direction, similar to the Chinese government doing rate cuts, doing some tax cuts are in the pipeline, cutting mortgage rates, and doing stimulus at the margins to just boost things as they come out of their COVID lockdown recovery, et cetera. But we are seeing a lot of green shoots. Anyone doing business in China that's reported earnings has been very, very constructive, particularly on the last 8 to 10 weeks of activity in China. You're seeing it obviously in the casinos in Macau. You're seeing it in Wyndham, some of the hotels. You saw it in the Chinese internet companies. In aggregate, EBITDA was up 30% amongst the big handful of internet companies. Revenues were up 7%. So I think that there's a tremendous amount of pessimism around emerging markets in China in particular, which is 40% of emerging markets. But I think when you look through and you see the Fed getting out of the way, which is going to create an environment where the dollar stays subdued. You know, it came off of that big rally in October and it stayed down pretty much. You've got some counter trend rallies of late. But if the dollar stays weak, I think you're going to see a huge flow into emerging markets in the near term, and that should last for multi-years. China is going to be a major beneficiary as the Fed finishes the tightening cycle and all of emerging markets. So I like the fact that relations are thawing. I like the fact that stimulus is coming in China. I like the fact that earnings are good in China. So we remain constructive on high quality companies over there that are growing earnings and cash flow. We own Alibaba.
Thomas, thank you for your time.
Thanks for having me.